Okay, it's 8:05, so we'll get started. Thank you, everyone, for attending our first seminar of 2023. We're going to discuss why we've been investing in Calgary and why we like the opportunities there. So some more information on myself. I'm owner and broker record at Remax Wealth Builders, selling real estate in Toronto for over 12 years. #1 Remax agent on Ontario individual transactions for 2019. #5 Remax agent in Canada, an individual 2020 this year. #9 agent worldwide this year, up to October. That's the stats we have for inducted the Remax Hall of Fame, awarded the Remax Lifetime Achievement Award at 35, awarded Remax Circle of Legends Award this year, but none of that matters to you at all. What does matter is investing. And I've been investing since 2012, so 10 years now. And my initial investment of $39,300 deposit on my first pre-construction condo, I've turned that down to a $17 million portfolio, which includes 15 condos, a triplex in High Park in Toronto, and an apartment building in Hamilton. And the most of my buying has actually, since 2019, has occurred in the Calgary market. And I like to be transparent with everyone. So here's my, there we go. Here's my actual portfolio. So total value of it, current market value is just over $17 million. And I do this A, to be transparent, and also B, I want to show you the value of buying and holding real estate. Especially now that they've changed the tax laws, which I like, actually. So the change in the tax laws is that if you were to sell a property less than 1 year after purchasing it, instead of a capital gains being applicable, you would have to take the full profit and income. So what that means is if you were to apply the capital gains exemption, that means 50% of the profit would be taken into income at your whatever tax rate you're at. But if you were to sell that before the end of 1 year, then you're gonna have to take 100% of that profit into your income. So you're basically doubling the tax on it if you were to sell it in under a year. Why I like that, it really shows people the value of holding on to the real estate. And that's what I do. I buy and I hold. And I've done that over 10 years. And I show this slide. So in 30 years, at a simple compounded annual 3% growth rate, this entire portfolio would be worth $42 million. And why I say over 30 years is over 30 years, my mortgage will be paid off because amortization periods for mortgages are 30 years long. And I didn't pay them off. A tenant paid them off. So this is my pension plan. I built my own pension plan doing this. And I go a little deeper. This slide as well. Just want to let everyone know, in 2022 alone, we helped over 350 people from across Canada invest in Calgary. And we've personally invested in 10 pre-construction units, the whole team has. So every one of the team has purchased an investment condo in Calgary. We all believe in the market in Calgary. And in Niesh case, Niesh, what are you at with your family members?
6.
Yeah, so that's 6, and that 6 isn't even included in the 10. He and then his family have purchased even beyond that. So we speak it, we live it, we breathe it. Now going back to my portfolio, where I predict it'll be worth $42 million in 30 years at that compounded annual 3% growth. There's that word inflation, and you guys hear about inflation too. It's top of mind in the news. But again, when you look at things spread out over a 30-year period, everything flattens out in the curve. So what I did is like, well, what's the actual true value of that in 30 years? So what I did is I went back 30 years and I looked at what the value of this property would have been 30 years ago. And that gives me what the current market value of, the time value of the money today. Now my team tells me sometimes people get lost in this slide, but what I'm trying to say with this is that $42 million in 30 years doesn't mean I have $42 million in today's purchasing power. So I want to be as transparent as possible. I want people to understand. So that what that $42 million means is that I will have $23 million. It would be the equivalent of having $23 million today, is what I'm saying. And I can buy the same goods today worth $23 million that I can in 30 years. So if I take that 23 million, which again is fully paid off, tenants have paid that off, I could apply a 5% annual rate of return on that, and I could pay myself a salary of 1.1 million without eating into the equity of the property. Now I probably want to reinvest 2% of that to protect against inflation, because if we go back, because again, inflation's in the news. If I look at what over 30 years, what the annual rate of inflation was 1.96. That's over 30 years, right? Over 30 years. Yes, we have a big spike right now, but that's going to be flattened out. And that's the beauty of time. So if I reinvest 2% of protect against inflation, I'll be able to live off nearly 700,000 a year. And why I show this slide is I could live off 700,000 and I will still have a portfolio that's maintaining its value that I can pass on to future generations. Again, I'm sorry if I'm losing anyone on this, but why I do this is I want people to understand that you can build a portfolio that you can live off of for your future. So you're building financial freedom. So we like to say outline financial freedom, invest in real estate to build financial freedom for yourself in the future. And then part 2 of that is build generational wealth. So by investing in real estate, you can build that generational wealth for the next generation. I can say I did not get generational wealth. Niesh, did you get generational wealth?
Negative. Nope.
I know you didn't, but we are trying to give our future generations a leg up. We're not giving them a handout by any means, and I know Niesh definitely not going to give his kid a handout. But you want to give them opportunities that we weren't exposed to, and if we can, let's say, open a door for them, we want that they can walk through, right? Open a crack and they can walk through. That's what we want to do. Open those doors for them, or at least open them a crack. So that when I say I got a portfolio of 17 billion, that may scare some people off. Now, again, this is something I do day to day. I've been doing it. So I started in 2008. So now we're coming on 15 years of doing this and investing for 10 years. That may be daunting for people, but again, I do this day to day. So I wanted to simplify this for everyone. So I showed people, well, what if I had $1 million portfolio, $2 million portfolio, or $3 million portfolio? Well, the value of that, you look at what the value is in 30 years, I adjust that for inflation. And here's what I can actually pay myself in a salary on a 5% ROI, return on investment. So in 30 years, with today's purchasing power, so the equivalent of, I could be able to buy whatever I can buy for $70,000 today. I could pay myself $70,000 a year in 30 years if I had $1 million real estate portfolio. And again, that $1 million may seem like a big number, but that is 100% achievable. That's 2 to 3 properties. And then, okay, what about 2 million? What about 3 million? All of these numbers are completely achievable. And that's why I show this in this scale, so that you can really take steps to build that for yourself. And how can you do that? Some people will use their home to fund that. So using a home equity line of credit. So what a home equity line of credit would be is that over the last 10 years, your property has gone up in value. And this is a technique that I have used to continue to grow my portfolio. I've used lines of credit off of my principal residence. I've used I've refinanced existing investment condos, and I kept on rolling that back into the real estate so that I could grow that larger portfolio. And that's what I've done. Because if your property has gone up in value significantly, well, that's great, but you're not earning any money from that, right? Excuse me. And the only way to unlock that, 2 ways you can unlock it. Number one, you can sell the property, but then you don't have a house. Or number 2, if you can leverage the property and then put a new investment asset, that's where you can make money from it. And what the beauty of what I love about real estate is that it can match an income stream to that leverage, to that interest expense, which is the rent that someone's bringing in. And each $350,000 condo represents $24,000 of annual income in your retirement years. So again, you could only own one piece of property. You do a great job. You pay off that property. But then when you're 65 years old, and you're looking at, well, what do I have for savings? Yeah, maybe it had some savings, and maybe your employer had some sort of pension plan set up for you, but the majority of wealth will probably be tied up in your home. But what if you could just keep that home, and if you leverage that home earlier on in your life cycle, then you could have multiple properties, right? That's the beauty of real estate. What you're doing is you're applying two finite assets. The two finite assets are real estate. What I mean by finite, there's only so much land in the world. That's a finite supply of land. And number two, time. Unfortunately, we're all going to die, and we have a finite amount of time. When you apply those two concepts together over a longer period of time, you can build tremendous wealth. So why Calgary? Well, what I want to say to everyone is, when I bought that first condo in 2012, that first investment condo in Toronto was a one-bedroom condo in Queen West, and I bought that for about $260,000. That condo today is worth $650,000. I can't get you, and that condo cash flow. I can't do that today anymore in Toronto. If I'm looking at a starter one-bedroom condo in downtown Toronto in pre-construction, I'm looking at 700,000 plus today. And I can't make the math work on that on a standard 20% down payment. What I see in Calgary, and what I've seen since 2019, is that I can do that. And I have pricing that is still significantly below Toronto, and I see tremendous growth. And we're going to get into why I see tremendous growth there. So why Calgary? Most livable city in North America, most livable city in the world, fourth most livable city in the world, top 5 of the Economist Intelligence Unit's Global Livability Index. That's for the last 10 consecutive years. It's located in the foothills of the Canadian Rockies, loads of green space, and second lowest cost of living in Canada. And that is such a key factor when we're going to be going through everything. The second lowest cost of living in Canada, 9th lowest in North America. And it's sunny there. Like, I know, I live in Toronto, and I was saying to my wife on Sunday, it was supposed to be sunny on Sunday, and it wasn't. And I feel like it hasn't been sunny. Niesh, when's the last time it was sunny in Toronto? Like, I swear it's been a while.
I want to say August, maybe.
Oh my God.
It's been a while.
Like 3 I don't know. We have people from across Canada on here, so I don't know when everyone's kids started back in school, but my kids only started back in school on Monday, and I have 3, and they're young. 3 kids, 5 and under. And you have this gloomy weather out there, and you're stuck in the house. It's depressing. In Calgary, it's the sunniest city in Canada with an average of 2,300 sun-filled hours. It's a green city, ranked the 2nd for healthiest lifestyle and life satisfaction major cities in Canada, and the most extensive outdoor pathway network. It's a beautiful city, and it's sunny. And I don't know, whatever it is, being in my 40s now, but I swear, like, when the sun doesn't come out, it does impact my mood. So if you do have some seasonality disorder, the sun really makes a difference. And outside the city, 5 world-class ski resorts within 2 hours, over 200 hiking trails in Banff National Park, and it's only 1.5 hour drive to Banff. And that's a true 1.5 hour drive, versus where we talk about our Muskoka, which is our cottage country. That's only a 2 hour drive if you leave at 2 in the morning in peak times, but it's always only a 1.5 hour drive to Banff. So you're really close to a world-renowned playground. So why are Alex, Kyle, and Niesh investing in Calgary? Well, when you're investing in real estate, you're investing in roofs over heads. So if you're investing in roofs over heads, you want to make sure that the population is growing. And the population of Calgary is growing. When we look back at the numbers, 2019 to 2020, it's grew by 44,000 people, 2020 to 2021, 34,000 people, 2021 to 2022, 29,000 people. So we have a growing population. And the next slide is even more exciting. Calgary also has money. It has the highest millionaires per capita of major Canadian cities. It also, they have high wages. Calgary represents the highest wages and salaries per employee in the country at over $66,000. But if we look at yes, I want to make sure the population is growing today. What's the population growing in the future? So I looked at what it's done in the past, but now I'm looking at what it's doing in the future. And this is all Statistics Canada data. So Alberta's population is set to increase by 48% and will be larger than British Columbia by 2043. So over those 2 decades, Ontario population is set to increase by 24%. Still a good number, but Alberta is going to grow by twice that rate. And Alberta is going to grow by 48%, but Calgary is going to grow even more. So the population of the city is about 1.6 million people. That's going to grow by 1 million people over the next 2 decades. So the growth of Calgary over the next 2 decades will be 62.5%. That's a crazy, crazy, crazy number. Now, if you're investing in roofs over heads, you get very, very excited about seeing that number. You want to be investing in areas where the population is growing. And if you look at the stats, there's only going to be 3 areas of major growth over the next 20 years in Canada: Ontario, British Columbia, and Alberta. We know what the pricing is in BC. We know what the pricing is in Ontario. And we're not even talking about the taxes yet, which we'll get into a second. And then you have Alberta, which is a fraction of the cost of British Columbia and Ontario. And then when you get to our major metropolitan centers, our GTA, our Greater Toronto area and our Greater Vancouver area, with incredibly high pricing and incredibly high taxes, Alberta is going to grow. Calgary is going to grow. And again, this is Statistics Canada data. And that's where talking about the 2nd lowest cost of living in Canada, 9th lowest cost of living in North America, that is massive, 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 massive. And we've seen it. We've already seen the growth since we've been investing since 2019. And again, when we follow the money, you also look at the economic stats. So you look at the economic stats, the largest economic cities, Toronto, Montreal, Vancouver, number 4 is Calgary. Its economy is bigger than the province of Saskatchewan. Its economy is bigger than the province of Manitoba. That's where things start getting really exciting. So buy low, sell high. So as we've seen a increase in real estate values, or I'll back this up. When I started buying in Calgary in 2019, people were like, "Well, you're crazy," and people are like, "Well, what has been the price growth year over year?" I'm like, "Well, it's been negative. It's been going down." I'm like, because the people I've talked to were like, "We're used to Ontario and the GTA and prices going up every year," right? Well, what I did is I looked at, well, where is the prices going down? And then when you look at the underlying data, of the population growth, and you're like, well, wait a second. Okay, prices went down, but they are going to come up again. So why did the prices go down? Well, what you had happen in Alberta is in 2007, 2008, you're looking at $150 a barrel oil. And you had a rapid buildup investment in Alberta in the oil and gas industry. And that led to a rapid buildup of real estate in Calgary. But what happened was the price fell out of oil and prices went down. And then there was layoffs, which then there weren't new bodies to put into the houses, and housing prices went down. And then it sat like that for a while. Here's the thing, though, is that it stayed down for too long, and there's just a negative cloud over Calgary for too long, and it kept prices down for too long. And with that, you had a rapid buildup of commercial space, which you're going to get into more. But what I tell people is that you can't lay off people that have already been laid off. So Calgary hit a bottomed out with job layoffs. And then what you had is you had new companies that were moving into the space. Now, on top of that, there's also been diversification. So not diversification, sorry, distribution. So when you look at the worldwide situation that we're in now, and you look at commodity prices, you look at the price of oil, the majority of our oil goes to the US. And we have difficulty reaching international markets because Alberta is landlocked. But we have something that as Canadians that we own called the Trans Mountain Pipeline, and that's set to open this year. And what that's going to do is that's going to increase our exports of oil around the world, which will stabilize Alberta oil prices. Because when there are shocks to the oil prices in the American market, that significantly impacts the price of oil in the Alberta market. But once we have the Trans Mountain Pipeline up and running, that'll increase our international exports by 13%, help stabilize the price of Alberta oil. It will continue to leave Alberta and Calgary and even Canada in general in a much, much better financial and stable financial position, which again, we're going to get into, and you're going to see the numbers more so. So Alberta is running significant surpluses in their budget, which allow them to diversify their economy. And when you had all these layoffs in the oil and gas industry, and you had a rapid buildup of commercial space because of high oil prices prior to that, you were left with a bunch of empty office space, and vacancy rates hit 30% in Calgary. But guess what started trickling in? Other industries, specifically the tech industry. And Calgary Economic Development is bullish on the city's prospects in annual community report. Calgary outpaced from a tech workplace standpoint everyone else in North America. So we're seeing significant growth in the tech sector in Calgary. And on top of that, with where we are in the global economic climate, where we are with our low Canadian dollar, low cost is a great place to be. So in Alberta, you have low cost office space, you have low cost workers because of the Canadian dollar, and you have low cost taxes. Calgary ranked in the global top 10 most attractive cities for workers. Calgary has the highest proportion of STEM graduates of major Canadian cities, and that low cost office space. And how low cost is that office space? I'll jump at that in a second. But Calgary is home to 435 technology companies, 3/4 of these startups. And there are more than 2,000 open tech jobs in the city, and a record 44,500 Calgarians are working in tech right now. So how low cost is that office space? Well, the office space in Calgary averages $17.50 per square foot versus $21 in Edmonton, 23% more, $35 in Toronto, over double, and $44 in Vancouver, nearly triple, over triple what the space is in Calgary. So you have that low cost office space for these tech companies to operate in. And who's coming in? Well, we talked about those startups. So startups are coming to fruition. So those startups are starting to hit unicorn status. One of the most recent one, Neo Financial, became Calgary's latest $1 billion tech unicorn. Neo Financial's employee headcount has swelled to 650 people, and the company is actively recruiting for another 100 positions in Calgary. Amazon, they're opening a new cloud computing server hub. It'll be the second in Canada. The other one is in Montreal, it'll be their Western computing hub. It's a $4.3 billion investment, 900 jobs. TELUS opened their new 60-story TELUS Sky, state-of-the-art headquarters in downtown Calgary. They're hiring 8,500 people in Alberta, part of a $17 billion investment in operations and network in Alberta. WestJet is now making Calgary its only connecting hub within its global network. And I want to highlight that for a second. Another thing that Calgary has, and when I put it on par with the other three major Canadian centers in Canada, being Toronto, Montreal, Vancouver, there are only 4 true international airports in Canada. And that was highlighted in COVID because there was only 4 international airports open in Canada. That means places that international flights could arrive. And that was in Toronto, Montreal, Vancouver, and Calgary. WestJet is now making Calgary its only connecting hub within its global network. So that means you're going to have all these international flights landing in Calgary, and then they're going to be connecting out of there. Who likes that? International head offices, because they want to be able to get specifically to the city that their offices are in. It's a multi-billion-dollar asset investment into Calgary and the airport, relocating all of its 787 Dreamliners to Calgary and 1,000 direct jobs. This one excites me, and I know it excites Niesh. De Havilland Aircraft of Canada Limited. This one's cool. So you may not know who de Havilland is, but they've been around for over 100 years. And they've been building planes in Toronto in the Downsview facility. They're relocating everything out of Toronto, and they're moving into Calgary. They're building a massive aircraft manufacturing complex just east of Calgary, be 1,500 acres of land with runway, facilities, head office, training, everything is being moved there. And again, it'll result in 1,500 jobs. Now, not a sexy name, but you know what they build? They build water bombers and other I don't want to say rural aircraft, but they're rugged aircraft. So they're meant for exploration and rugged climates. But we also know with climate change and forest fires around the world, water bombers are needed. So there'll be no shortage of orders coming in from planes from de Havilland. So that's happening, and that's a relocation. So what that means is all the jobs in Toronto are being eliminated, and all those people have to move to Calgary. So those are 1,500 people that'll need new homes in Calgary that are getting well-paying jobs. Infosys. Infosys is one of the largest IT consulting companies in Canada. So not in Canada, one of the largest IT consulting companies in the world. They opened a head office in Calgary, doubling jobs from 500 to 1,000, and with plans. So that's in Calgary, doubling jobs from 500 to 1,000, with plans to double their entire Canadian workforce to 8,000 people by 2024. Infosys, another massive global IT consulting firm, opened a new delivery center in downtown Calgary, 1,000 jobs over 2 years. And these are international companies. These are companies that are taking advantage of the Calgary environment. SideTrade, artificial intelligence company, opening new headquarters in downtown Calgary, 110 jobs. TD Bank opened their new Western Canadian wealth hub in downtown Calgary, 100 financial planners. Calgary has the highest population post-secondary education individuals in Canada. Very, very relevant. RBC has opened a new Calgary Innovation Hub. They're adding 300 jobs. Ernst & Young, they're setting up a new finance hub in Calgary, 200 jobs. IBM, they just opened a new innovation hub, and this resulted in one of our fastest sales, Gallery, which sold in September in downtown Calgary. Those condos sold out in about 2 weeks. 250 jobs. That Gallery building is right across the street from their new innovation hub, IBM's. So we're talking about all these companies that are moving to Calgary. And how do I know that'll continue? Because I've seen it happen in the States, okay? So when I look at the States, I look at, okay, I have companies leaving California, and I have companies leaving New York, Massachusetts. They're leaving high tax areas and they're moving to low tax areas. They're leaving areas with expensive housing to low cost housing for their employees. And where are these companies moving? They're moving to Texas and they're moving to Florida, because you have low income tax or low tax environments and affordable housing for my employees. So instead of having offices in San Francisco and paying some of the highest rent, and my workers are making 6 figures and they can't even afford to live there and they got to sleep on a buddy's couch, or they could be in Houston and they can have affordable housing, so they can have a nice house. And from a company perspective, they're in a much lower tax bracket regime, and their employees are in a lower tax bracket as well. So Alberta, similar situation. Alberta has the lowest corporate tax rates in Canada, and I believe it's by 3%. They also have no provincial sales tax. And then for us investors, there's no land transfer tax and development charges. I was in a call this week, and I had someone asking me, "Oh, Alex, well, what are the closing costs coming?" This was in the ERA project that, which was the first project that we bought in. And I told them there's none. And they're like, are you kidding me? I'm like, no, there's no extra cost on closing. And they were absolutely blown away because they're used to buying here in Toronto. And they also have a condo that they bought pre-construction that's closing this year as well. And they know that the closing costs on that condo in Toronto. So that's when I factor in my HST rebate, which is $24,000. The land transfer tax will be around $20,000. And then with development charges will be probably another $16,000 or more. They're going to have to come up with another $60,000 on closing. And your costs have to come up in Calgary and closing are zero, other than my down payment required by the bank. That's significant. Expensive housing. Calgary housing, second lowest cost of living at all major Canadian cities, and 9th lowest in North America. Limited red tape in Alberta compared to our other jurisdictions, and government regulations. That's where you have a government that there's no rent control. The being a landlord in Alberta is so much more attractive than being a landlord in Ontario. There's no rent control. You can do fixed term leases, so your tenant leaves after 1 year. Your eviction process is 2 weeks to a month versus 8 months here, if someone isn't paying. So there's such attractive things there, and the government, who's running a surplus, is able to invest in the areas to attract diversification away from the oil and gas industry. And that's where we get into here. So when I look at the net financial debt per capita in Alberta, I'm less than $2,500 per person in Alberta. The average in Canada is over $10,000. The average the net financial debt in Ontario is nearly $19,000. So what that allows is the government flexibility to make investments in other industries to diversify their economy. And they're running surpluses now. So again, with the conflict in Europe, with Ukraine and Russia, and we've seen oil prices go up. Western Canada, their last fiscal year had a $13 billion budget surplus. And they're going to use that money to pay down debt, which then allows their operating funds to be in a much better financial position. They're also forecasting a surplus in 2023, 2024 of nearly $1 billion, and followed by next year of $700 million the following year. This budget is based on $70 a barrel of oil, which we are still higher at today. When I listened to the radio this morning, it was at $74 a barrel. Any disruptions in the global supply chain will lead to increases in that price of oil. Many experts predict us to hit $150 a barrel of oil in the future, because it doesn't take much of a disruption to impact oil prices. I see Niche's eyes just opened up, but because we haven't talked about that a lot. But yeah, it's predicted we'll hit $150 a barrel of oil regularly, and that's due to geopolitical issues. It's a scarce resource, and when you look at where are oil producing nations and what's the geographical politics in those areas, well, let's look at the Middle East. Is that a stable area? West Africa, Venezuela. He's making notes now. These when you look at where oil comes from, Canada is in a great position to be a trusted, secure provider of commodities. And that's not just oil and gas, that's all our commodities. We're a commodity based country, just like Australia is. So we're a true first world country. We're a true democracy. We're not a autocracy. We're not a dictatorship. In the world that we're entering in now, with the deglobalization, people will be looking at where can I get safe, secure supplies of commodities, and that's where Canada is in a good position. I'm not going to go too far down that rabbit hole. Pro policy, this is Alberta: no rent control, no foreign buyer tax, no land transfer tax, no provincial sale tax, no development charges, and a $10 billion stimulus package, including reducing corporate taxes. They initiated that at the beginning of COVID. And this is where we've seen incredible growth over the last year in the rental market. And Niesh, I'll let you talk more about this, and because you had your townhome that you recently rented out. So I'll let you talk about rental rates and the appreciation you saw in that asset.
Yeah, absolutely. So of course, with the growing population, the need for housing is very severe. And when this happens, of course, prices are going to go up, especially in the rental market space. So with our partners that we work with, Truman specifically, they provide, certain incentives like rental guarantees, and they provide a set rate when you buy into the program, or when you buy a property. But what I saw in less than a year, there was a significant increase in what the rental guarantee provided versus what the market was able to sustain. Nearly a $500 difference in the monthly rent that we were able to secure. So as a result, of this huge increase in the rental market, and also, of course, driven by the vacancy rate, it was easier for me, much easier, even using the interest rates that we're dealing with today, to still be cash flow positive. And again, you're not going to see that anywhere in any other major cities, especially in places like Toronto and Vancouver. It's just not going to be possible. So we expect the rental market to continue to be on the upward trajectory. We may not see a 30% increase in 2023, but we are going to still see a significant increase because the population is growing. And the need for housing is still quite severe. So when it comes to investing with confidence, there is the tenant and landlord benefit of Alberta versus Ontario. But on top of that, there's also the financial win in terms of the dollar per square foot you can charge as rent compared to the purchase price. So.
And when we were looking at sales last in September, sales of condos grew 66% year to date over 2021. Row houses rose 54% year to date over 2021. I believe in October, condos were 27% higher year to date. So we're seeing a jump in the demand for condos, because guess what? That's affordable. And I saw the same thing happen in Toronto. In 2014, 2015, people were like, well, why are you investing in condos? Why don't you buy houses? And condos are easy, but I saw growth potential in condos, because I was like, well, people can't afford houses. So yeah, I have a finite supply of houses, and that supply is constrained. I can only build so many houses. But there's only going to be a certain number of the population can afford houses, and then the rest of people will have to live in condos. And that's where we saw tremendous growth in the value of condos from 2016 onward until even today. And even in today's market right now, this is specifically to the GTA market, condo values are holding their own, and it's a freehold market that is going down right now, and that's due to affordability constraints. When I look at if I have to qualify the stress test right now at over 7% to get a mortgage, well, that's going to impact my affordability, and still prices me out of houses in Toronto. So where do I move? I start in my condo, and I can tell you that the young population even want to own houses. Houses are a pain in the ass. Niesh doesn't even live in a house. He loves his condo, right? Like, houses are garbage. And maybe I have some people like yelling at me on their computer screens right now. But I live in Toronto. My house is a pain in the ass. And I miss my condo living because I had someone else do everything for me. It was great. So if we look at, okay, well, if I'm in my 20s, do I want to do yard maintenance? No. Do I even know how to take care of a house? No. Would I rather be going to ski in Banff and go play in the Rocky Mountains on the weekend? Yes. So why do I want to live in my house? Now I have 3 kids. I have to, like, yeah, it's hard. It'd be hard for me to live in a condo. But there are people that have 1 kid that live in condos for sure here in Toronto, and have 2 kids that live in condos. We're seeing new schools being built in downtown Toronto. Yes, we're talking about Calgary right now, but you got to be forward thinking and see where things are going. And people don't necessarily want to live in houses. And the idea of living in a freehold house is a very North American thing. If I were to go around the world, what we have in subdivisions don't exist. These aren't things out there. The majority of the world lives in condo buildings. So,
and speaking of that, Alex, when we talk about the job growth, especially in the high tech sector, and just in general, there's a lot of immigration as well coming in to Calgary, and most of the immigration are from places where, as Alex said, freehold homes, big yards and stuff isn't the norm. So the type of lifestyle and the type of living people are used to kind of aligns with the type of products that are available in Calgary. You build up, you don't necessarily have the ability to build out. And additionally, you're talking about some of the graduates that come out of these STEM focused schools, and many of them aren't having kids right away, or they're maybe only having 1 child. So the need for those huge backyards and $3,000 square foot homes isn't what it used to be. And that's why we're seeing the increase in products like condos and row houses.
Yeah, for sure. And yeah, it's something that we saw nearly 10 years ago in Toronto, and that's what I predict to see in Calgary. And this is where talking about values holding their own. When we look at values, and we look on the scale, this slide here, great slide, shows you how values have gone down. So so if we look down here, these markets went up in value significantly over the last 2 years, and now they're having the largest pullback. So February 2020 to peak. So if we look at, for example, let's say Barrie went up, well, a significant amount, nearly went up like 85%, but right now they're down 13%. Net gain is good, but that was from February 2020. So if you bought in February 2020, yeah, you're down, but you're up. But imagine if you bought it at peak market, and now you're down 13%. Calgary hasn't gone down. Over the pandemic, it went up about 24%, but you haven't given up any of your gains, right? So you're in a great situation. Why is that? Well, guess what? Their market did crap for a decade, right? I talk about buying at the bottom. Well, prices have gone up, but they have such more room to grow up because they basically had a lost decade in valuations. Where the rest of Canada was going up in value, Calgary didn't go up in value. So now we're making up for that lost decade. Great line, isn't it? Lost decade. First time I used it, like that one. Lost decade. We're making that up. Condos have not hit the record highs from 2014, right? The pricing, we're still below 2014 pricing in Calgary. So we're making up for that lost decade. Excuse me. Too much talking. And this is where we've seen people follow us. We consistently throughout 2022 sold out properties: Frontier condos, Cabello condos, Skyview condos, Harlow condos, Pine Creek townhomes, and it goes on and on and on. Our current projects, we have a 5% down option closing in 2027. and I didn't even get into talk about mortgages, but all these are pre-construction. So what that means is they're not closing today, they're closing at some point in the future, and you're putting a deposit down on these properties. What that means is you're also you'll be paying lower mortgage rates in the future. Mortgage rates will be going down, and we've really peaked out in regards to our interest rate increase. I don't want to say schedule, but the where we've been seeing increases throughout 2022 mortgage rates, you'll start seeing those mortgage rates starts pulling back. It's expected in the second part of 2023, and when you buy pre-construction, you get the advantage of like, well, I'll get to participate in the lower interest rate environment in the future. So we have plaza condos, which you're able to buy in 5% down. Those close in 2027. We have freehold houses, not just in Chelsea, which Niesh can tell you a lot about, which is right the closest community to the new de Havilland Airport complex. those freehold houses started around $499, right, Niesh?
Correct. Yeah, $499.
We have freehold houses, $499. Broward, we have downtown condos there. Those close in 2027. Those are 10% down, but we have an interesting, or no, I should say amazing, not interesting, amazing. It's interesting and amazing interest relief program there, which offers which in essence buys down your mortgage rate to 1.99%. And then we also have some townhomes in Southwest Calgary, Barfield, townhome Southwest being a very desirable area of the city.
Alex, do you mind just going back to the previous slide where you had the graph with the different pricing changes? I want to make a quick point on this particular slide, especially when we're looking at Toronto and looking at where the market has gone over the last 2 years. Now, when you buy pre-construction, of course, you're buying a couple of years out and you have a certain value that you're buying it at. But the thing is, at closing, you need to get financing. Right? You need to get financing, and typically the bank will loan you 80% of the mortgage. Now, what happens if you buy at a time where you always thought that the prices were going to continuously go up from a appreciation standpoint, and now you have a condo that's closing in February in Toronto? The bank's going to look at the value of the property. They're going to look at what you need to borrow. They're going to be like, no, we're not going to be lending you 80%. You got to come up with more of a down payment. So not only are you now hit with all the other closing fees that you have to pay in Ontario, including land transfer taxes, levies, fees, and all that stuff, but out of pocket, you're going to have to come up with another 5, 10, 15, 20% in some cases. My personal experience with the property that I closed on in August, and again, this is really when things start to go sideways with the rates, was I purchased a townhouse back in June of 2021 for $380,000. When I got the bank appraisal, it was almost $100,000 more than what I bought it for. And we know banks, to the point that I made earlier, they're going to come in notoriously lower than what the market value is. So right then and there, I was just able to generate $100,000 in equity, and I didn't really need to do anything. So another reason why buying low in a place like Calgary and letting the market do its thing will benefit you down the road is because the ceiling is much higher. Whereas in other places, we might have peaked a little bit, we might have hit the ceiling, and we're seeing, unfortunately, some of the negative impacts of inflated prices.
Great point. Great points, Niesh. Yeah, no, it's some interesting times in Toronto in 2023. But again, Calgary's not going to experience that pain because they didn't have that run up. Like, that's where buy low. People thought I was crazy in 2019. They're like, you're insane. Why are you buying there? But I've seen prices hold. So yeah, going more into the incentive packages. So 3-bedroom semi-detached freehold homes, those $499 to $509 with a $15,000 cash back in closing, free garage. Only 10% down, 5% now, 5% in 90 days. So it's closed in spring 2024. The Broward condos, those come with parking. They have a 2-year rental guarantee. They close in 2027. And then they have the interest rate protection plan. So what that ends up being, it's a credit on closing, an additional credit on closing for you, which essentially buys down your rate. So if you're interested in that, we can send you, well, you'll get more information on that when we, this is being recorded, so you get a recap of this. And you'll have additional information on that, and you can book a call with us and we can go into more details about that program. And yeah, if you want to learn more, you can get in touch. But I'm going to open the floor to questions. So I'm going to stop the share here. Again, everyone's going to get a recap of what we're discussing today. So if you have any questions, you can ask the questions down below in the Q&A box.